So I think the first thing I'd say here is that there are times when you're managing wealth for clients, managing money, that you focus on the return side of things, the performance side of things. And there are times where you focus more on capital preservation. And clearly, already coming into the Ukraine crisis, we were more towards a capital preservation mindset, mainly because we feel equities are in a bit of a sour spot at the moment. You have the combination that the big macro background picture really is one of the Fed tightening, a debate over whether the cyclical spike in inflation we've seen becomes something more permanent, more secular. As the Fed embark on the end of QE and perhaps QT, there's a draining of dollar liquidity out of the system. All of that happened at a time where valuations in some sectors, mainly tech and growth, were pretty expensive. And then you have this whole uncertainty now over Ukraine, energy prices, inflation, the geopolitical situation. So in my career, I can't remember a time really where things have been more uncertain than they are at the moment, or certainly you have to go back a long way for that. And therefore, from our point of view, with capital preservation mindset, we've already made a number of changes to our portfolios, which on balance make them more defensive, more balanced, more diversified, as we feel that we're navigating our way through a period of uncertainty.
Can I ask you what that means for European markets? Because we saw over the course of February, stock market was starting to grind south anyway. And as we start out a brand new month of March, as you point to all the uncertainty, do you think that there is an opportunity still for European stock markets this year? Or is that narrative just completely changed now at this point?
I think there's always opportunity, both Europe, US, and globally. I think Europe is clearly the area that is most potentially negatively impacted by what's going on in Ukraine. Higher energy prices for longer, higher inflation for longer, the impact on European confidence, European economic activity. So there's no question that Europe will potentially see the biggest negative impact on growth and impact on sticky inflation, inflation higher for longer going forward. So, but equally, I think what it means probably is that it very much means that the European Central Bank will be unable to raise interest rates, perhaps for this cycle, for some time to come. They'll have to make sure that there's plenty of liquidity in the system. And globally, if this leads to, I agree with something that Ian, one of the previous people, spoke at earlier. I think we're going through this tightening period for the Fed, but ultimately our expectation is that interest rates globally cannot go materially higher this cycle due to some of the secular trends at play, which are putting downward pressure on growth and inflation. That's true in the US, it's true in Europe, it's true in the UK, and it's pretty much true globally. So ultimately, coming out of this, when we have a bit more clarity about the end game in Ukraine, when we perhaps see some of these inflationary pressures easing, and we think inflation is peaking at the moment, some of these pressures, when we see maybe the Fed have to pivot a little bit towards a more dovish stance sometime down the path, and we recognise that the ECB too have to continue to be very dovish, particularly as governments focus more and more spending in areas like defence, addressing some of the income wealth inequality and so on. Then ultimately interest rates aren't going materially higher, and as long as central banks don't make a mistake, it should be bullish for equities.